Y'all, this is Mindy Strong, back with another video to help you with your Series 65 preparation. I am in the investment recommendation section, financial profile of a client, and we are going to dive into the different types of clients. This financial profile section is pretty big, so I actually divided it into two videos, and you can find the other video after this one, but this is the basis of understanding the different types of clients. So without further ado, here we go. There are three types of customers. There are personal customers, institutional customers, and fiduciary customers. Okay, so personal customers are going to have individual accounts, and they can denote a transfer on death, which is a TOD, and this avoids probate and lengthy hoop jumping. So they have a named beneficiary. Makes it easier so that their loved ones don't have to go through the pain in the neck that is probate. There is a Totten Trust, which is a bank account that can be opened with a beneficiary that is named to receive the account balance upon death of the owner. Smart, also a way to avoid probate. Totten Trust. Joint account. Okay. So there are some different ways you can set up joint accounts, and they each serve a different purpose. Let's look at them. You have the happy couple there, walking there. It looks like a golden retriever, but they know that they're not going to live forever. Okay, here we go. Joint account. It's a signed joint account document is needed. These are often used for spouses, so one can easily access all of the monies upon the death of his or her spouse. So there are a couple of these, you don't have to be married. And the first one we're going to look at sometimes can be used in a business partnership. Joint tenants with rights of survivorship. What is that? Well, each of these people have undivided interest in the account. If one of them dies, the other becomes the sole owner. And again, this can be used for any two people. They don't have to be legally married. So if people go into business together, this might be a great idea of making it easy for if one business owner dies, for the other one to have access. Okay, joint tenants with rights of survivorship don't have to be legally married. Tenants by entireties. These people must be married. Certain states have these. This protects the person from being sued and half of their assets taken. So the joint tenants with rights of survivorship does not protect you from losing 50% of, that's not faux, that's of assets if other is sued. I put faux in there to make sure you're awake and you're paying attention. Or I made a mistake. It's one of the two. Okay, tenants by entireties must be married, but it keeps your money safe. Tenants in common. Okay, in this case, each has a percentage of interest, and when that person dies, that percentage goes to their estate. And this is often used among business partners as well. So both of these, joint tenants with rights of survivorship, don't have to be legally married. Tenants in common don't have to be legally married. And again, tenants in common each has a percent of interest. When the person dies, the percent goes to their estate. Cool. Family limited partnership account. Family members are partners in this venture, in this situation. They have a joint venture. The parents are generally the owners of the trust. The children are the limited partners with no management role. And this can be used to take advantage of estate tax credits, usually used among pretty wealthy people or people that own a family business. And here are some more account types. I like how they go in and out. That's fun. I didn't do that. It just happens. Okay, sole proprietorship, sole props. You are doing business as, you're the business owner. It's owned by one person. If you want to use a different name, then you must file a doing business as with the state. You must file a 1040 and a Schedule C, which shows your profits and losses. And there is unlimited liability of all debt. You are a sole prop. You are the person responsible. And then there is something called a general partnership. This is when two or more people form a general partnership. Must also be filed in some states. Each person is seen as a percentage of profit and loss. The partnership is not taxable. Each person claims the profits on their and their losses on their individual tax return. And again, it's unlimited liability of all business debt. Okay. Got it. Cool. A limited partnership account. Okay. So you can have a general manager and you can have passive investors. There are passive investors, which is direct participation partnership. At least you have to have at least one general partner and one limited partner. The general manager has unlimited liability, and everybody claims this on their personal tax returns. Now, the tax basis is also called the cost basis. You are going to see cost basis and tax basis used a lot during the Series 65. That's the taxable amount, cost basis, the basis that will be taxed. Okay. And that can be found through the original investment plus partnership debt assumed and plus or minus the gains or losses. And original investment plus the partnership debt that's assumed plus or minus gains or losses. And then you have the passive investor's loss. Sitting back, look how passive they are with their money. Their loss is going to be limited to their investment in the partnership. And again, they claim everything on their personal tax returns. Okay, so all of these so far, we're claiming on our personal tax returns. Now we're going to look at a C corporation account. This is a taxable entity. It's taxed as a whole. The net income or loss is calculated and the company must pay. Notice company starts with a C, and this is a C corp. If they pay dividends after tax, then the shareholders must pay taxes on it as well. So it's called double taxed. The certificate of incorporation must be paid to the state to form these, so they become incorporated. This is the first in which the company is liable for the taxes. Then there's an S corp. Notice it starts with an S. This is an entity with 100 or less shareholders, and you pay those taxes yourself. S corp, you pay the taxes yourself. Less than 100 people, less than 100 shareholders, or 100 or less. The taxes are filed on your personal tax returns. There you go. This could be a small family business as well. That's why I chose that picture. Everyone's so happy. Look how happy they are. Limited liability company account. This is neither a corporation nor a partnership. Okay, so we're going to compare and contrast. Like the S corp, remember it had self in it, and the partnerships, the shareholders pay taxes themselves in a limited liability company account. LLC, you've heard of LLCs before. This is an LLC. It's not limited to 100 or less, like an S corp. They are considered members of the LLC, not shareholders and partners, and they can take a membership role. There is limited liability, and everybody pays their own taxes. LLC. Okay, moving on. Now we're going to talk about fiduciary customers. So we talked about personal, now we're going to look at, and we talked about institutional customers. Now we're going to look at fiduciary customers. Okay, look at how fancy this slide is. Okay, a trust account is an account in which a trustee, trust account, has a trustee who manages the assets for a beneficiary. I'm so dumb. Settlor. So the settlor creates the trust. Think of this example of a mom. She's creating the trust for her daughter. She's donating to the trust. She sets the objectives of the trust. She names the beneficiary, which in this case is her daughter, and she names a trustee, and there's the trustee. That trustee is the fiduciary. So we have the settlor, we have the beneficiary, and we have the trustee. Okay? Got it. Makes complete sense. This is a trust account and how it's set up. So what is the responsibility of a fiduciary? Well, they have to abide by the Prudent Man Rule. Only investments that would be made by a prudent individual can be made. That's the definition. And a legal list involves a list of investments that can be made. It's determined by the state. Usually only has the top 4 classes, the trusted investment types, and a copy of the agreement must be given. There's something called inter vivos trust, which can be revocable or non-revocable. And inter vivo means during one's life. Okay, so the trust can be set up that can give money during one's life. And then there is a testamentary trust. These are non-revocable. This is typically in one's will upon death. Okay, non-revocable versus revocable or non-revocable will be discussed later when it comes to tax implications. Oh, you didn't have to wait very long at all, did you? Revocable versus non-revocable. Revocable, man, it's hard to say that word over and over again, y'all. Revocable means you can revoke it, right? You can change your mind, okay, about the money you're putting in. So you can put money into it, but then you can revoke. You can take that money back. So revocable, the trustor can revoke the trust. It is seen and taxed as personal income, which means at a higher rate, up to 37%, at a higher rate if it's revocable, but you have the option to change your mind. Non-revocable is taxed at trust rates, which are between 15 and 20%. Okay, so there's an advantage, tax advantage to having a non-revocable trust. Revocable, non-revocable. Whoa. Okay, now there is something called a bypass trust, and we're not talking about a heart issue. This is a trust for married couples. So I'm going to give you the example of these two lovely people. A-B trust. It minimizes the estate tax. Look at how happy they are. And they're happy because they know they've protected each other from taxes. The assets are placed into 2 separate accounts when one dies. So in this case, we're going to have B die, okay? Because B is a boy. Typically, men die before women, and I'm a woman, so I chose the man to die. I'm just kidding. I love men. Okay, so A trust has surviving spouse's assets. So when person B dies, they divide up the assets. So A's trust has the surviving spouse, which is A's assets. The taxes are deferred on this one until death. And the surviving spouse, A, uses B trust first, which has the estate tax exemption. So it's a way to not have to pay taxes on what B is leaving behind. Make sense? It's called a bypass trust. So you get to bypass the person left behind and the tax implications. Cool. There's also something called a second marriage trust. So, Q-tip, qualified terminable interest property trust. It is irrevocable, non-revocable, same thing, in which the surviving spouse Okay, so let's say a man is married once. We'll do this. She was married to him, and they had a great life together. And then she got remarried to him, and they had a great life together. So what had happened was, she leaves everything in her trust to, I don't like that example. Let me think. Okay, I like it. So she was married to him, and then she got remarried to him. No, I don't like this example. Okay, irrevocable trust in which the surviving spouse receives assets until death. When the surviving spouse dies, the remaining assets are given to the named beneficiary. I got it. Okay. They're married. It's a second marriage. He had all these kids from another marriage. So he says, listen, kids from my first marriage, when Sally dies, you will get everything that's left over, but I want to leave everything to Sally to help her out when I die until she dies. And once she dies, then you guys will have everything that's left over. And because they like Sally, they're okay with it. So he was married before. He had these children with another person. He gets remarried, and he says, all right, here's the deal. If I die before her, she's going to get all of these assets. But when she dies, whatever's left, give it to my kids from my first marriage. Boom. There we go. That's an example. Sorry that took so long. I would redo this video, but, I don't want to. Charitable trust. Here we go. This is my favorite slide. I'm so in love with this slide. Charitable trust. Okay, so we have a grantor of a trust that can be the trustee. And the donor of these monies gets the tax benefit. The trust can either be set up for a fixed number of years and then pay out, or it can pay out when the trustee dies. The grantor of the trust chooses that. Okay, here we go. Charitable lead trust. The donor retains control of the assets, gets the tax deduction every year for the contributions until he or she dies, and then the grantor gets to choose who those funds go to. Okay, so let's look at this example. We have a cat lady. She loves cats. She has 18 cats in her house. She has always been a cat person. She donates to the Cat Foundation, the SPCA, but specifically in the name of Fluffy, her cat. And she's going to continue to retain control of those assets that she puts in that charitable trust. She gets the tax deduction for it every year until the day she dies. And all those deductions are going to the Cat Foundation. But what she says is, listen, when I die, I want whatever's left in that trust to go to my family. And the family is sad she's died, but they are very grateful because it's going to pay for their college. And she knows that. Okay, that is an example of a charitable lead trust. Charitable remainder trust. This one's a little bit different. Here we go. Charitable remainder trust. It's basically the opposite of a charitable lead trust. So the annual income that this person puts into the trust goes directly to the beneficiaries. There's no tax deduction. They have to claim it. But then upon their death of the beneficiaries, the remainder goes to a charity. Okay, so listen, we set up this charitable remainder trust. We want everything to go to our family until they die, and then we want everything to be donated. Charitable remainder trust. Okay, cool. Next. Donor advised fund. This allows investors, like community foundations or religious organizations, to donate directly to a charity. But to retain control of the assets. They get an immediate tax deduction, but the contributions are irrevocable. Okay, so this is an irrevocable trust. Any other assets in the trust grow tax-free, and then the donor decides how to invest. They qualify as public charities, and fees are assessed. So again, these are typically religious organizations or community foundations. They donate directly to a charity, but they are able to retain control of the assets. They do get a tax deduction, but once they put those contributions in there, they're irrevocable. Got it? Cool. And then we have a foundation. So we hear about people setting up foundations when someone dies. Wealthy individuals and families can set up a foundation instead of a trust for charitable contributions. Unlike a trust, this has an indefinite life until, that's supposed to say until, all assets are gone. They can't accept donations from multiple sources. So it's donation forever, foundation. It's like a fountain of donations. It goes on forever. Estate account. The goal of the executive of an estate, no pressure, is to pay the liabilities first and then to pay the beneficiaries. Duh, that's what has to happen. It might take years. Now, his or her goal is to try to earn a reasonable return on the assets, also duh, and they require a certified copy of the death certificate in order to open such an account. So it's an estate account. The executive is the person in charge of this, must pay the liabilities first, try to get as much as you can on the assets, and then you give the rest to the beneficiaries. Okay, got it. Pretty simple. That is the end of this section. Hopefully this has given you a good foundation that you can use moving forward. You definitely want to watch my next video as I dive deeper into this section.